Today, we look at part 2 of Raoul Pal's podcast with Tim Bilyea. In this highlight, Raoul Pal reveals his shocking prediction for crypto's new bottom in the wake of the FTX crash. Be sure to stay until the end because Pal reveals what crypto he expects could fail next so that you'll stay one step ahead.
Top level is, above all things, it starts with the macro. And then we'll get into the more specifics later because that will come into your questions. The macro for me has been, are things turning? Is inflation coming off? And is therefore the rate of change of rate increases going to reduce or not? So my view is that we've seen the peak in CPI. The market's starting to realize that they've been overestimating CPI, and therefore inflation is going to start coming off. We saw that with PPI today as well. And I think we'll start to see unemployment pick up, whether it's this month or next month. Those are the signals the Fed is looking for to slow down. So when they slow down, it's the rate of change of interest rates that matter, whether they do another 50 and another 25 or another 50. Either way, we're getting towards the end of the rate cycle where they will pause. The pause is enough for the market to perceive it as the lack of pressure holding this balloon underwater. And when you take it off, the balloon can rise. And we've already seen the equity market take that well. I don't believe that means if the equity market's going up, inflation's coming back all over again, we're in a big mess. I just think the Fed just stay on pause and wait for inflation to fall below the Fed funds rate. My guess is inflation will be below 4% sometime around February, March of next year. And in which case, if it continues to fall, which is my base case, in fact, I think inflation goes negative, then we will see the Fed eventually pivoting and going to rate cuts instead to stimulate. But that game is to be played for. Right now, it's a matter of the end of the macro story and liquidity coming. The global liquidity cycle is currently led by China. Chinese liquidity has turned up, and I put a tweet around this amongst all of my macro crypto views. Chinese liquidity leads, global M2 should follow. And as we start getting through the liquidity cycle, liquidity is one of the key drivers of crypto. Crypto is driven by two things: the technology, which is Metcalfe's law, the adoption of that technology and its uses, which is Metcalfe's law, to remind you, is the number of connections on the network and the number of people on the network and the number of connections. So how much network activity is there amongst how many people? So that is Metcalfe's law. That's the technological driver that drives the exponential growth. In the middle, you have cycles. The cycles are driven by liquidity, same as all assets. And liquidity being drawn out as M2 shrinks, the Fed raise rates, other central bank raise rates, means that crypto falls. As liquidity flattens out and starts turning up, then crypto rises, as do other risk assets. So that's the basic cycle. Where we are now is the liquidity cycle has now met the bottom of the exponential trend, the adoption trend, and that becomes an extremely interesting time to focus on accumulating crypto. What also happens at the bottom of liquidity cycles is things blow up. Less money around means those worst borrowers and people who have abused capital tend to blow up. And we saw that starting in June in the crypto markets as the centralized finance part, the CeFi part of crypto, blew up as credit became less available, and you start seeing who's swimming naked when the tide goes out. And there was a whole bunch of people swimming naked. What we didn't realize is there was a naked whale, and the naked whale was FTX and Alameda. And that was something where it appears from what we know that Alameda went bust in June, and out of that, they tried to paper over the cracks with customer money to hide the issues because it would have brought down the exchange anyway because of the tie-ups with the FTT token. And then this whole thing gets exposed by CZ, but really the market needed to know this stuff. So that's where we are now. And I know we're going to have a lot of questions about knock-on effects of that. So I am very focused on crypto right now, as I am the macro cycle, because they've met at the important part, which is the bottom of the liquidity cycle and right on that secular uptrend of whether it's the 2 standard deviations oversold in the log regression channel of Bitcoin or whatever thing you want to use. to show that we're there now. Now, that doesn't mean I'm saying the price needs to have entirely bottomed. I think actually ETH bottomed in June, but I don't know yet. Could it have a further spike back down to 1,000? I don't think it takes out the 700 and whatever low that we had, but let's wait and see. FTX Alameda failure is on everybody's mind. The contagion does not seem to be contained. What other failures and market adjustments could we expect? How much long could this take to play out? I have a slightly variant view, but you can't have much confidence. I think most of the bad leverage was taken out in June, and this was the final part that should have happened in June but didn't. So what are the knock-on effects? Well, normally if Alameda had gone bust, the knock-on effects would have been Celsius and BlockFi, etc. They already went bust. So we've got the knock-on effects of FTX having bought them and then can't fund them. But I think that was a kind of known failure. So is there somebody bigger here that is yet to get knocked on? Some people have looked at the banks like Silvergate. It's possible. I don't think that it's systemic for the banks in that respect, the crypto banks. Signature, Silvergate, those two are the main lenders in the system. What I do know is there's a lot of hedge funds trapped in FTX because FTX was really the avenue for the ability to short markets via the perpetuals. So a lot of hedge funds use them and they've got that assets trapped, which is a shitty situation for everybody involved. And I don't know how that resolves. I got caught out in MF Global myself. It was very similar. It took a while before we got our money back, but we got a big first tranche back. And then eventually over time, as the administrators and liquidators sorted it out, we got the rest back, but that took years. So that's one of the reasons I think the markets have been less aggressively pricing the downside. It's difficult to short the markets. A lot of the hedge funds won't use Binance, for example, because they can't get it through compliance. And a lot of the other products aren't available on the other exchanges. So it's kind of muted the market, which is why it's been so quiet. But there could be other shoes to drop. I don't know really who they are or what they are. People have been looking at Genesis, Jump, and the other market making firms. Is it possible? Well, they've all said no, but as we know, that means nothing in this world because everybody says, no, we're all fine. We're just going to have to wait and see. But I am biased towards if there is another sell-off, you want to start aggressively adding into it because the macro cycle is turning. And I think this is the final phase, the capitulation phase. And, I've been around this market since 2013, and I've been through all of these and I've seen all of them. And the sentiment is as shitty as I've ever seen it for obvious reasons. A lot of people have lost a lot of money being caught in all of these kind of fake crypto, which is, they're centralized, they're opaque, they lend your money out in ways that you don't understand to give you a yield which you're grateful for until you realize that you've had open-ended risk on the back of it, which is one of the reasons I've said, please don't use yield. Staking yield is fine as long as you understand that your risk is the currency that you're staking in, which is Ethereum or Solana or whatever it is. That moves up and down. You're going to make or lose money according to that. But the yield is relatively safe because it's written into a smart contract. Yield otherwise, I don't like. I don't take it. I don't use it.
If you enjoyed that, click here to watch financial expert Raoul Pal reveal the biggest misconception that all amateur investors get wrong about crypto so that you'll be able to make far more gains than losses on your future crypto investments.